Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, May 2nd, and then we'll see how things look for Wednesday, May 3rd. Greetings from Warsaw, Poland, left Nuremberg, Germany, after a brief stop in Berlin, came all the way to Warsaw, arrived at about 2 a.m. local time, kind of dragging a little bit, posting this a little bit later than usual. This is going to be another unedited, at least as far as my audio is concerned, video, because it took me all day to revamp what I'm showing you. Hopefully this one will be a lot more organized than the last one, but the sound may still not be quite up to par. But anyway, I'm doing the best that I can given the time that I have to work with. Before I get started, yes, please note that I am traveling. I still have about a week and a half to 2 weeks before I'll return and get back to where I usually record. As I'm able to do so, I will post the daily video updates. I'm looking at the weekly and intermarket analysis charts every day. If there's anything interesting, I may just combine that into the daily video. I'm kind of letting the Isabel Net charts and some of the Twitter posts and some of the blog posts and other things that I usually include, I'm letting that go for right now. It just takes so much time to put all that together, and I wanted to organize just what I present here in this video. I do have a podcast that's available, and I'm also rethinking that. Right now, it's just an idea. The way it is standing right now, the podcast that you see is a carbon copy of what you're watching right now. I may go to the point where I actually record a separate audio podcast. It's just an idea at this point. We'll see how that works out. No matter what you look at, whether it's the YouTube video or the podcast or on Rumble, the PDF is available in the description that shows all the slides and charts so you can follow along. I do have a private Facebook group that you're welcome to join, and I'm posting things as I'm traveling to say, well, I can't really do a video today. Here's some charts that are interesting, or I'm not going to be able to do anything. That's kind of my point of interest. I'm also posting those same things on the community tab in the YouTube channel. I don't have that capability in Rumble. Also, let me know if there are other platforms that you want me to post to. Right now, I post to LinkedIn, I have Blogger, I go to Facebook, and some other ones. I don't use Instagram all that much, and I do post to Twitter. But if there are platforms that you use that it would be more helpful to see some of the charts that I look at that maybe I don't talk about in the videos, please let me know about that. And I don't have a poll posted right now. I just didn't get around to doing that, even though that's not real time consuming. I've been focused on doing some other things. All right, let's go back and talk about what happened on Tuesday, May 2nd at the open. We had a gap lower open, and we went down pretty big, not on a percentage basis, but because Monday's range was so small, the pivot levels were quite close to each other. We went all the way down to S4 at one point, and I don't recall ever having to post that on the chart that I'll show you. We went down below S1, S2, S3, and even S4. As the day went on, we got back above S4, but we were not able to get back up to S3. We were down 1.16% on above average volume. That's another thing to be aware of. A pretty big down day with volume really picking up. That's a warning sign. The technicals, they're kind of in the middle right now. You could lean more towards positive or negative. We're right in between, but we're seeing a lot of negative divergences right now, and that's what I'm really going to be stressing in this video. So there's a lot of charts that show you this. These are warning signs that we look at. We're right in the middle of earnings season. We have some Fed speak that's going to be coming out with the release of the announcement by the Fed. And then there's been more banking information that has come out that I'll briefly go through. What are some comments that we can make? There are real concerns developing over an economic slowdown. For a while, bad news was good news. Well, now we're getting to the point where bad news is starting to turn into bad news, and that could really have an impact on the market. And that can shift and change over time. European stocks were down pretty heavy in Tuesday's session, and that carried over into the U.S. session. Bank stocks showed a lot of weakness again, and I have a couple of new banks to show you charts later on. There are worries about the debt ceiling. We're finally getting to that point where this is starting to be dealt with. Treasury Secretary Yellen, in her beautiful angelic voice, Why doesn't she sing opera? I don't know. She warned that the Treasury is unlikely to be able to continue to satisfy all of the government's obligations by June, and this could even be as early as June 1st. That's kind of setting the markets into panic mode. This is a political ploy that goes on in Washington, D.C., but for the markets, hey, something needs to be dealt with here. This could really affect our bond markets, which could come over and affect the stock market. But there's a lot of political posturing that always goes on with these things. On a short-term basis, we only have our stochastics that are overbought. Everything else is pretty much in between now. The dollar was down and interest rates were also down. The 30 to the 5 is back to being normal, where the rest of the yield curves that we look at remain inverted. Sentiment is at neutral. 50 or so is the neutral point. Right now we're at 52, where we had been at 52. Our trend is more negative, and it's getting stronger. The red line's starting to go up. It's crossed above the green line. I'll show you the chart. But overall, the ADX is below its moving average, and both of those are still below 20, so we're really in a non-trending environment. Our bias is negative with the down day, and I've kept our momentum at negative just because Tuesday was really pretty negative overall. We'll have to see if we can get any bounce in Wednesday's session. Economic reports that came out, we had the job openings at 9.50 million. That's down from the 9.9 million we had last time. And to come in a little bit out of order here, we had factory orders that were up 0.9%. They expected them to be up 1.4%. Last time they were down 1.1%. So this is a little bit more weakness that we're seeing coming in. The job numbers are starting to drop off. The factory orders are starting to drop off. Even though it was up, it wasn't as much as had been expected. And that's what the market is starting to fixate on. The first thing is I did go to FactSet blog just because this is really relevant to what we're going through right now. At the headline, it says analysts are making smaller cuts than average so far in the second quarter. Given concerns in the market about a possible economic slowdown or recession, have analysts lowered their earnings per share estimates more than normal for the S&P 500 in the second quarter? The answer is no. During the month of April, analysts have lowered their estimates for the second quarter, but by a smaller margin than average. This is part of the posturing that's coming on, so that they lower their estimates. The company comes out with their earnings. They beat their earnings, so the stock is all happy and things are going really nice. But you need to know more of the backstory. What led up to them actually beating those earning estimates in the first place? Here's some charts showing how in the first quarter, how the estimates have been coming down. This also shows how the earnings have been going back up slightly. And here we have the price compared to that, because when they come out and they beat estimates, everybody just has a party, and a lot of times the stock will go up. Here's another comparison chart on the bottom as well, just showing how the earnings estimates are coming back up slightly. Here's another look at Amazon. They're the largest contributor to the expected earnings growth so far in 2023. This is the discretionary sector, and then if you take out Amazon, this is how it would have performed overall in the first quarter and then for the current year so far. And then the earnings growth, if you take out Amazon, it's really looking pretty bleak right now. That's why we're seeing a lot of negative divergences. That's why we're seeing the big stocks doing quite well, but the rest of the stocks are kind of being left behind. Another thing, Fed watch right before it happens. So the latest reading that we had was that the Fed is going to raise interest rates another 0.25%. Right now, there's an 86.7% probability. After they make their announcement at 2 p.m. Eastern, that'll probably be a 100% probability. Then looking at some of our charts, first we look at the intraday analysis. We can see here where we did gap lower. We went quickly down below S1, S2, S3, even fell below S4. Got a little bit under the 4100 level where a base was established. We tried to come back up, but we never made it all the way back up to S3. Intraday, showing pretty much the same thing. In the overnight session and the pre-market session, we are seeing a little bit of a bounce in the SPY market right now. When we're looking at large cap growth versus large cap value, both really suffered. and growth is actually underperforming value a little bit. But when we look at this, it was down, but it was down less with the large caps, mid caps, and even with the small caps. Looking at sentiment, the Ulster Index still is suggesting that there's not a lot of fear in the market. The equity put call ratio is starting to go back up. It's not above 0.8 yet, so we're keeping an eye on this. When it goes above 0.8, that's considered to be an extreme reading. That sometimes can mark a bottom in the market and give some support to stocks. Looking at the VIX, it's ticking back up, but it's still very low. We're still below the 20 mark, both on the line chart and on the bar chart. Then this is a newer chart where I'm taking the VIX and doing a ratio with the VIX of the VIX to measure this action overall. Typically, when we're going down and having trouble, this ratio will be going up. When things are turning more positive, this is going down. On the bottom, this is just a moving average of this ratio to give us an idea of what direction it's headed. And it is headed lower, which is meaning there's fear coming out of the market. Then this is another chart taking the current VIX and then looking at the 3-month average of the VIX to see if there's some kind of a ratio. And overall, this has been falling, also showing that there's not a lot of fear in the market. Here's the VIX of the VIX by itself, where with the down day, we did go up with volatility, both with the bar chart and with the line chart. And then we look at the MOVE index on top, which is the volatility index for bonds, but it's moving up slightly with volatility as the VIX also spiked up with the down day. And then the correlation is still very strong between the two. The SKU index, where the VIX measures the at-the-money options, the SKU index looks at out-of-the-money options, both above and below current price. It's not giving us a real extreme reading right now. When we get up to this red area, that's when they get really fearful about things. When we get down to this blue area, that means there's a lot of complacency. Right now, we're just about in the middle. Then another fear gauge that we look at, kind of starting to tick back up, even though it did decline in Tuesday's session. Here's another fear gauge, also ticking back up slightly. It's probably a little hard to see. And then looking at the risk on versus risk off environment, folks are still tending to favor a risk off environment, meaning that they're getting out of stocks and going into bonds. Then we have advanced decline line. We're still working off of this negative divergence here. We were down both based on price and volume. On a short-term basis, we're a little more negative because the volume dropped below the moving average. Or longer term, we're also seeing this negative divergence between price and volume, which could feed into some weakness in the market. The advanced decline ratio is still above 0, but it is declining. Looking at the new highs, new lows, not really breaking out. Our 5 period is still continuing to decline, turning down just slightly with our 10 period. Accumulation distribution, this is still positive. We're still above an advancing moving average. The advanced decline line is still looking okay. It's pretty much matching price with the S&P 500. But here, when we look at just the common stock, the advanced decline line made a higher low recently, where we're making a lower low based on volume. That's another longer-term negative divergence. Here's another look where the S&P almost got back to previous highs, but the cumulative advanced decline line is not even close to that. In fact, it really declined in Tuesday's session. When you look at the NYSE decline line on a shorter-term basis, we're also showing a negative divergence. Then here's the NYSE advanced decline line dropping below the moving average. The S&P is still above the moving average, as are the mid caps, but the small caps continue to show some weakness. Looking at our trend, here's the ADX, where the red line is crossing back above the green line. Because these lines are so close to each other, the ADX is declining. It's still well below 20, and it's still well below its moving average. We still default to the negative because the red line is now starting to go on top. Then with that is volume. It has picked up a little bit. It's still not all that gangbuster, especially when we were going up. But now that we're going down, we're seeing volume start to increase, and that is rather negative. Some short-term charts. First, looking at the daily chart, we came right up to this resistance level that we just cannot seem to get above before coming back down. On the positive side, the S1 level here was set up as the pivot. You can see on the bottom where we did go above average on a down day. We're right in between the 20-period simple and exponential moving averages. Those are the short-term moving averages that we look at. This could provide some support, especially if we go higher. If we break down below that, that will turn things more negative. Our short-term stochastics, we're coming down in the short term. Intermediate term is still rather extreme positive, and the longer-term stochastic is still rolling over and extreme positive. The force index is kind of right around the midpoint right now, so not really helping us. Looking at some intermediate term charts, the balance of power, we're still above the dashed line, and even with the down day, it did advance slightly. We're still above the double and triple exponential moving averages. This blue line, the double exponential moving average, may be providing some support. If we continue to fall, we'll go back to the anchored moving average, which is measured from the all-time high. The go-no-go system is still with a blue bar, which is more positive to neutral. And then here's the longer-term chart where we're still above this anchored moving average. If we continue to fall, which right now is at the 40.76 level, we'll be watching that as support. The TTM squeeze is starting to show some renewed weakness here. The blue bars are darker. We're heading more towards the zero line. We're seeing some red dots here, and that is turning things more negative. We're coming back down to the midpoint of our standard deviations. We had gone up to the +2 standard deviation. Now we're coming back down. We're just at the midpoint currently. Our PPO studies, we're still okay with the long and intermediate term. We're starting to turn more negative in the short term. The Arun indicator, after giving us an extreme positive reading, is now starting to come back down. The Swinland Trading Oscillator, this could potentially be positive. It was up and crossed above zero based on price on a down day. We're still below zero, but it did advance based on volume. McClellan Oscillator, seeing a pretty big divergence right here. The S&P has been going up, but the McClellan Oscillator has not been matching that rise. When we look at the broader range, NYSE, also seeing a negative divergence. The PMO study, pretty much right on top of the moving average. We're a little bit negative and trying to turn back up based on price. We're still declining based on volume. Our other PMO study shows a negative divergence with the PMOs that are rising. We were going up with the S&P. We're going down with those PMOs that are rising. The buy signals continue to decline, and the percent of PMOs that are above zero also continue to fall. The Elder Impulse system has switched to negative. Parabolic SAR, still positive overall, even with the down day. The dots are underneath. Looking at our oscillators, trying to turn back up, but still negative with the slope. The TSI is kind of crossed over its moving average. The MACD is a little confused right now, as is the PMO and PPO. Our TRIX is also right on top of the moving average. The KST is starting to turn slightly negative. We'll be watching the 50-period moving averages to see if they provide some kind of support. The simple moving average is at 4,036, where the exponential moving average is at 4,066. Looking at our moving average tree, showing how we came back down into the 20s, but we're still above the 50s and 100s. The BPI starting to come down, and we're also starting to develop a negative divergence where the S&P had been going up, but we're not going up that strong with the BPI. Looking at our broader range BPI, we've crossed down below zero. That's more negative. The Chaikin money flow still positive, but declining. The Chaikin oscillator is also declining, but still above zero. The money flow index turned down slightly and is still above 50. The ultimate oscillator also above 50, but declining. The vortex showing some weakness here, but the green line is still on top. Our summation index based on price is starting to turn down, and it's turning down again based on volume. On balance volume, we've come right down to this moving average. Will that provide some support? Then looking at those stocks that are above their 200-day moving average, we're seeing negative divergences. The S&P was going up. The 200-period moving averages were not going up, and we're seeing the same negative divergence with the 50-period moving average. Looking at our Fibonacci levels and line studies, we never were able to break through this quadrant level that has provided some pretty significant overhead resistance. Looking at our short-term Fib charts, we were above the 100% retracement. We've now fallen down below that. If we go back up, this may turn into resistance, which is now at 41.23. Longer term, also bumping into this 50% retracement level at 41.56, we've fallen back down. If we see some rise out of this, we'll be looking at that 41.56 level as potential resistance. Longer term, if we continue to fall, we're looking at the 40-20 level. Then different charts. Our Heiken Ashi chart is turning more negative. The Kegi chart is still positive with the black line, but it's pointed down, so that's with a negative bias. The Renko is still positive. The 3-line break is still positive. And then looking at some other indexes, the equal weight index is continuing to underperform the S&P 500. That's because all these big companies are doing well, but the rest of the stocks are not. Here's another look at the equal weight ratio where the big stocks are starting to outperform. Then looking at new Dow theory, we were able to break above this blue line, but now we're starting to come back down. Will that act as support if we continue to fall? We never were able to break out with the NASDAQ, and that is a bit of a concern. The transports continue to underperform the Dow. That can often lead to further weakness. The Dow fell below this pivot level and was not able to break out much at all, but it's still above its 50-period and 200-period moving averages. The diamonds have switched to negative. The NASDAQ has been chopping sideways and could be falling from what now could be a quadruple top. The NASDAQ 100 also has pretty much been chopping sideways. We're still above this pivot level, which may provide some support. The Qs have switched to neutral, and the NASDAQ 100 now dropping back down to the 12,864 level if we continue to fall. Will that provide support? Small caps continue to really break down. They came all the way down to S1, found some support there, but we've seen a recent death cross now with the 50 crossing below the 200-period moving average. Here's another look at the small caps. The RSI has dropped below 50. The MACD is also turned down. We never were able to get back above the 200-day moving average. The small caps are really underperforming the S&P 500, and they've switched back to negative for the Elders Impulse system. The mid caps, which had been going okay along this pivot level, now they've dropped down below their 200-day moving average. They've also switched to negative. But micro caps are getting really close to setting another 52-week low. The home builders are holding up okay. They were down a little bit. And when we look at the ratio, it's still hanging in there, and the S&P and the home builders still have a pretty strong correlated relationship. Looking at the Qs, where we're still above this anchored moving average going back to the all-time high. This is currently at 314 for the Qs. Then some banking information. We're starting to see a breakdown again in the financials compared to the S&P. The regional banking ETF is really breaking down compared to the financial sector. Here's another new bank, PacWest Bancorp, which came on the radar. As of yesterday, it really declined almost 28%. And Western Alliance Bancorp also had a really bad day. Looking at bonds, we're still looking at the S&P compared to the long-term bonds. Longer term, they have a really strong correlation. Shorter term, they're going in opposite directions. The spread is still pretty high between the two, even though it's decreasing slightly. Here's the bond yield showing how yields really did decline. Bond prices did advance in Tuesday's session. Long term, we're keeping an eye on the special K. It's right on top of the moving average now. And if you remember back to the beginning of 2022, we cleanly closed below the special K, this red line, and that's when everything turned negative. If we can cleanly cross back above the red line here, could that turn things to long-term positive? Then our long-term trend, the MACD is still above zero and advancing, even though it's rolling over a little bit, suggesting that this breakout from this downward sloping trend line is still legitimate. Looking at our possible positive scenarios, the Qs are doing okay compared to the S&P. Discretionary is having a little bit of a problem, and large cap growth is outperforming large cap value, but not by very much. Looking at our growth to value ratios, we're doing okay with the large caps, not as good with the mid caps, and coming back up to the moving average with the small caps. The utilities, this is another thing that's actually negative. In a good, healthy environment, we want to see this ratio really going up as the S&P is going up. It's not doing that. It's chopping around sideways to even declining. Then looking at the broad range of our Amex, NASDAQ, and NYSE highs minus the lows, and then taking a 5-period moving average, we're still below zero. That's negative. Our 10-day average of the highs minus the lows for the S&P is now continuing to drop after it had been positive for a number of days. The 50-period moving average of the new highs and lows, that continues to be positive. This is longer term because the indicator itself is still above zero. The NYSE breadth thrust also gave a really strong signal back in October. We're still working off of that, and we had a recent signal with the Zweig NYSE breadth thrust. That's still on the books as well, and that's longer term. The 2-year Treasury yield, after spiking up, coming back down, it's starting to go back up. Will that give some support to stocks? Now we're still looking at our staples to S&P 500 ratio. We took out these other spikes that we had been watching. We're starting to create a new spike currently. We're waiting to see how that will play out. What's our outlook for Wednesday? Earnings season is still among us. The technicals are showing some weakness, but there are numerous negative divergences, and that's really what I'm picking out right now. We have the FOMC announcement, which will come out at 2 p.m. Eastern time, and then the press conference after that. We'll have the weekly MBA mortgage index, as well as the ADP employment change, and the final reading, the IHS Market Services PMI, and then the big one will be the ISM non-manufacturing index. We have our geopolitical events right now, this day, unless something monstrous happens. We're still looking at what the Fed is going to do and say as being the real key. Looking at the Stock Traders Almanac, this is new for the month of May. The worst 6 months of the year begin in May. When we project ahead from May 15th through the 19th, that is options expiration. We're up 45% of the time, but down 55% of the time. And then the week after options expiration from the 22nd through the 26th, we're up 64% of the time and down 36% of the time. Looking at May 3rd, in and of itself, the Dow is up only 42.9% of the time. That's negative. The S&P is even more negative, being up 38.1% of the time. And the NASDAQ is also quite negative. But for the month of May, going back over the last 72 years, we've been up 59.7% of the time. We've been down 40.3% of the time. And then these are the positive backdrops that apply to the whole year. I'm not going to go through these again. I will go through them on a future video. I've switched this ahead to May, where a lot of times this green line, which is a pre-election year, we start off pretty good, but then May develops into some weakness. We're also seeing that same general pattern with this gray line showing that May begins all right, but then shows weakness later on. We're also coming out of that sweet spot where we were coming up high, and now we might be beginning to enter into some difficulty. Our scenarios kind of have to go with the down one right now, but we're seeing a real mixed picture because of all the things that are going on. But these negative divergences, that's the big deal that I seem to be picking out here. We can't really go with the up one right now because of all those divergences, so we're tending to go more with the sideways because the ADX is weakening. We're below the moving average, and both are below 20. It's negative. The red line has crossed above the green line, and it is advancing. So our warning signs, there are numerous negative divergences, and they're combining together right now. Volume did increase on a down day. The VIX is still showing a lot of complacency. The S&P is underperforming utilities. We're in a more risk-off posture. That's more negative for stocks. Small caps continue to underperform. The NASDAQ may be declining. It could be a quadruple top for all we know. And earnings season is underway, which could be positive or negative. On the positive side, many of our indicators are declining, but they're still suggesting that things are positive, but they are showing some weakness. The longer-term positive seasonality and setups, those are still in place. The NYSE breadth thrust, the Zweig breadth thrust, the longer-term indicators that we look at, those are still in the background. And then if we do continue to drop, lower price levels may end up providing some kind of support. So our conclusion, the S&P, it's not really trending right now, and it's showing a lot of negative divergences. In the short term, it is showing weakness as well as in the intermediate term, but we're still positive in the long term because we're above the 200-day simple moving average, and we had a recent golden cross. So thank you. I apologize again for the sound quality here. I hope this was more organized. I hope you found this helpful, and I will talk to you in the next video.